Hey there, business owners. Today we are going to talk about valuation and how particularly one specific metric in the valuation process can help or harm your business. My name is Andy Parrish, and I am the managing partner of a company called Alternate Solutions Consulting. We do a number of different things for businesses, including fractional CFO work, tax reduction strategies, and M&A and capital advisory strategies. So in my last video, we talked about how thinking like an investor can help improve your business, increase the value of your business. Today, I want to talk about how thinking like a financial analyst can help you prepare for the sales process and to help preserve your value. Okay. So, as analysts, we are often brought in to look at companies to figure out what should an investor pay for this company, right? From a company's perspective, when we're brought in by the business, we're brought in as valuation analysts to tell the business what they are worth, okay? Now, in order to do that, we have to build out specific formulas and models. When you go into the valuation world, the common term for modeling that you'll hear is the discounted cash flow model, or DCF model. Now, a lot of business owners, they talk to their broker or they talk to people in their industry and they talk about selling a business in terms of EBITDA or multiples of EBITDA, right? In reality, if you enter into due diligence with a sophisticated buyer or a sophisticated investor, they will hire somebody like us who have a financial analyst background to go into your company and build out a discounted cash flow model, which is essentially the present value of all future cash flows times a discount rate. The discount rate is what we're going to talk about, okay? So when you build out a discounted cash flow model, the lower the discount rate, the more money your company will be worth. So let's talk about that discount rate, okay? So the discount rate is traditionally made up of two different things: the cost of debt and the cost of equity, okay? Now, for publicly traded companies, the cost of debt and the cost of equity are mathematical formulas, right? Because you can use something called CAPM, which we don't have to get into. But for privately traded companies, we can figure out what the cost of debt is. But the cost of equity component is where valuation gets a little bit more subjective. And it's where a valuator can come in and slash the value of your company, okay? So company-specific risk is essentially all of, let me back up. Company-specific risk has to deal with the fact that your stock is not publicly traded. And there are all of these little factors that go into the fact that your company might be more risky than a publicly traded company. A couple of them are discount for lack of control. If you're only talking about a certain percentage, discount a certain percentage of the equity being valued, discount for lack of variability, there's key man issues, there is lack of market diversification, all of these types of things, right? So if a valuator comes in and says, yes, this company has strong cash flows, but their client base is really, they get 80% of their money from 3 clients, that's going to be something that gets factored into your company specific risk number. Okay. Now, I won't get into the actual details on, I won't go more into how the sausage is made on calculating the cost of equity, but it's, as a business owner, it's something you should be thinking about. Okay. The lower your cost of equity, the more money your company is worth. The way you get your cost of equity lower is by showing a buyer that they can make money running your business, showing them that there are not many risks, or that the risks that are out there have been accounted for through proper strategic planning, through processes, through written SOPs, so on and so forth. You essentially need to be able to counter any of the arguments for why your business is risky by having an answer, okay? And that's something that companies like mine help with. So, to review what we talked about, companies aren't always sold for multiples of EBITDA when you get to the higher due diligence level. In the higher due diligence level, most likely somebody will build out a discounted cash flow model of your company. Within that that DCF model, there's something called a company-specific risk element that goes into the discount rate. You want your discount rate Therefore, you want your company-specific risk rate to be as low as possible. And in order to do that, you need to be thinking about selling your company 2 to 5 years prior to the transaction actually going down. And I can do a whole another video on why that is, but proper strategic planning and being familiar with the pitfalls that business owners often face when they go to sell their business is very important. And that's all I really have to say about that for today. I've just thought of probably 3 or 4 other videos that I can do on this topic as I was speaking. But yeah, company-specific risk, know it and know how to mitigate it. Thanks. Hope to talk to you all and hope you enjoyed this video, and there'll be more to come.